Welcome to Learn Commerce PU online classes. Don't forget to like our video and subscribe our YouTube channel for all the updates.
Hello students, welcome to second PUC Accountancy online classes. Students, in the previous class we have discussed about the chapter financial statements. Now we will move on to a new chapter, that is analysis of financial statements. So we have to know what are financial statements. We know the meaning of financial statements very clearly. That is the summary of the total transactions done during a particular period of time. We will summarize it and we will present in the form of, that is a format as defined in the Companies Act, isn't it? That is the operating results of a business organization for a particular period, that is for a period of 1 month, isn't it? That is called financial statements. So we have studied the different types of financial statements, that is a statement of profit and loss and balance sheet or position statement, cash flow statement, isn't it? Those are all types of financial statements. Remember friends, types of financial statements, or they are called financial statements itself. Now, if we come to the other part, that is analysis and interpretation of financial statements, this is not compulsory to analyze. Analyzing or interpretation of financial statements is not compulsory. It is left to the management whether to do it or not. Because most of the managements, they need the data, that is which is bifurcated, isn't it? Bifurcated data regarding different, that is items, maybe expenditure or income. So for that reason, what they will do is they will reduce it to percentages, ratios, or any other form, or all the financial statements will be simplified to make the management to understand the statements in a better way. Because if we take up the financial results and the financial statements of a joint stock company, you will have a very big book, maybe 150 to 200 pages book. Okay, so is it possible for a busy person, a business magnate, to go through all those 200 pages or 150 pages? Not possible. Humanly not possible, because they will be tensed always. They will do the planning work rather than, that is a reading work, isn't it? Reading is waste for them. So what they will do is they will ask the, that is people who are managing, isn't it, the professional people who manage the business, to simplify the financial statement to make them understand it in a clear and better way. They will ask the professionals to segregate it into different categories, the items into different categories, total expenses incurred during this year, out of which salary part, how much, administrative expenses, material cost, isn't it, cost per unit of output, all these things, different items the management may ask the professionals to produce. Then the figures that are reflected in the financial statements will be reduced to ratios, percentages, or quotients, isn't it? All these things will be done, and then it will be given in a summarized form. Let me give best example, friends. When the results are announced of second PU board exam, the college will get this lengthy sheet of the results of the students. Maybe 10 to 12 pages results will be given. Is it possible for the management or the head of the institution to go through all the marks of each of the students? No. What they will do? They will segregate it. They will simplify it. They will reduce it to percentages, or that is groups and all these things, isn't it? They will use different statistical tools or different tools of the accounting, and then they will come to a conclusion. How many distinctions are there? How many 90 above are there? How many first class are there? How many second class and how many pass class are there? How many students have failed? What is the ratio of failure? What is the ratio of distinction? What is the ratio of there is a percentage of first class? All these things will be analyzed, or those things will be prepared by analyzing the data, that is a result sheet. Am I correct? When it is summarized and presented in a single page information, then it will be easy for the management to understand the results in a better way, so that they can plan ahead, they can go for that is a rectification, isn't it? They can go for that is a querying, isn't it, with those in whose subjects the percentage, this failure is more, or marks are not scored. So these things they can analyze and they can come to a conclusion. That is called interpretation, analysis and interpretation. When the financial statements are analyzed further or interpreted further to reduce it to ratios, percentages, statements, all those things, to make the management to understand it in a better way, the financial results of the business, then it is called analysis and interpretation of financial statements. Financial statement. This is the very meaning of analysis and interpretation. Clear? What is the importance of analysis? Why analysis is to be done? So, importance of financial statement analysis and interpretation. First point is that to whom it is important? For who are the people, those who need the information after analyzing and interpreting, or what is the importance for different people or stakeholders who interact with the business? First one is financial manager. Financial manager. It is very important for the financial manager to analyze and interpret, because he is the key person who plans the finance, isn't it? Who gives information to the management regarding the budget to be prepared, how much should be allocated for different centers, isn't it? Those things are done by this financial manager. So the financial manager needs the reduced, that is summarized form of that is financial statements, because he has to take a number of decisions, financial performance, operational efficiency, management efficiency, profit margin of the organization, isn't it? So all these things he has to analyze, so he needs the analysis and interpreted statements. Then second one is top management. Top management who is at the strategic level, isn't it? So they plan, they are there to plan only. Top management, maybe the managing director, directors, chief executive officer, president of the company, all these people come under the top management, who are the topmost officials, including company secretary, isn't it? They are the people who are responsible to do the strategic planning. So at the top level they will plan and they will make them to, they will make the lower level management people to implement the plans. So here, when the top management wants to take any decision, the management needs some sort of information. That information will be provided through the analysis and interpretation of financial statements. They will not be given, when they ask how much is the cost of that is revenue from operations, then you cannot give the entire ledger to the management, isn't it? Can they concentrate on that? No, they cannot. They need only the final figure, that's all. Because they want to do planning for that. They never ask you the detailed information regarding to whom you have sold, how much money is collected from them, how many parties are there. That is immaterial for them. For them, the ultimate figure is what is the total sales. Cash, how much? Credit, how much? That's all. Only 2-sentence information they need to do the planning. So financial analysis the financial statement analysis and interpretation required for top management also. Third one is creditors. Creditors. Who are the creditors? Creditors are the suppliers, isn't it? They supply goods and services or the raw materials or any spare parts or components to the organization. When they supply, they need information regarding the profit earning capacity, liquidity of the position of the company, because they want to know the repaying capacity of the business. When the banks offer loan, first they will ask you to provide all the information regarding your assets, like maybe how many cars do you have, how many two-wheelers you have, how many bungalows you have, isn't it? How many sites you have, where are you working, whether you are doing business or you are a service holder, what is your take-home salary, isn't it? All these information will be collected by the banker, because the banker wants to know the repaying capacity of the business. I already referred this point in my previous classes. A beggar will not get any loan just because he has no repaying capacity. He will not be in a position to repay the amount taken as loan, so no one will no one will lend loan to the beggar. And even the banks and other financial institutions, they never lend loan to the beggar, isn't it? Actually, who needs the money? Beggar needs it, isn't it? Badly he needs it, because he has to satisfy his basic needs. For that also he has no money, so he deserves to get loan. But whether he will get loan? No, he will not get. If you are tied, booted, and if you have so much of income, then banker will call you and will inform you that if you want any loan, if you want any cash credit, sir, we are ready to provide you. By seeing their passbook balance, isn't it? By seeing that is financial transactions with the bank, isn't it? By seeing that, they will say, sir, we will provide you loan. Even if the person didn't approach, they will call from their side and they will ask the customer to go for a loan, so that they can generate revenue, isn't it? But those who are in need, they will not be provided with the loan. My point here is, friends, creditors also, they always see the repaying capacity of the business. They will supply on credit basis only if the organization is sound, financially strong, fundamentally strong, they have sufficient reserves, they are earning bumper profits, so no problem for the suppliers. They will supply on credit basis because they know that money will be returned by the firm. They have enough resources, so no headache for us to recover the money. So that is the creditors, they need financial statements. Third one is lenders. As I already told you, lenders, the people who provide loan to the business organization, maybe the debenture holders. Long-term borrowings the organization will do. The business organization will borrow long-term loans in the form of debentures, isn't it? Or maybe long-term loans from other financial institutions, they will collect loan. This amount will be given by the lenders by seeing the repaying capacity or the profitability of the business. If there is bumper profit in the business, then lenders will be interested to lend loan to the organization, because they want to get secured in terms of repayment capacity and again the interest part, isn't it? Sometimes the person will get the banker will get the interest, isn't it? Later principal amount will not be returned by the borrower. That is losing hen for the egg, isn't it? You will get the eggs but no hen. If there is no hen, then gone, isn't it? Nothing can be recovered. So lenders also will be interested to see the financial statements. They want to see the interpreted, that is a part of the financial statement. Next one is investors. Investors are the people who purchase shares from the shares of the business. Suppose if I buy the shares of maybe that is say for example Larsen and Toubro Limited, L&T, isn't it? I will become the shareholder of the company, but I will be interested only if the L&T company is earning sufficient amount of profit and it is at a strong economic base. Whether I will be interested to invest in loss-making company or any other investor, whether they are interested to invest in loss-making company? No, because they hesitate whether they will get back their capital or not. That is a very important thing. If the share capital is not, that is recovered, what is the use then? What is the use of investing in the shares, isn't it? So that is very, very important. So investors also need financial statements to know what is the position of the company. Next, last one is labor unions. Labor unions. What do you mean by labor unions? The union of workers, friends. Union of workers. We call it as a trade union. Trade union does not mean that union of traders. It is a union of the workers. Workers union, isn't it? So here, trade unions, labor unions, they also will be interested to see the financial efficiency, operational efficiency, profit earning capacity of the business. Because why they are interested? First thing is that they are working over there, they work in that organization, so they will be interested to know how their status, what is the status of their company and the status of the employees. When you work in a good organization, a sound organization, then your that is status, individual status also will be increased in the society. Suppose there was a time someone is there in Infosys, means fine, good, he is in Infosys, wasn't it? Now there are as many number of companies as possible, that is IT companies are there, and there are some MNCs, multinational companies where people can get there is a handsome there's a remuneration, isn't it? So gone are the days, no competition. However you are, you should have proper talent and you should give proper output to the organization, then only you will get handsome salary or good salary. So that also matters. So labor unions, they will be interested to know how our company is performing. I am working in this organization, so how the company is working, what is my status, what is the status or reputation of the company, that also will be made known by the labor unions, just to make sure. And again, further they want to do bargaining, to increase their bargaining power. If the company is earning good amount of profit, then they can bargain for higher wages, increments, promotions, or any other benefits like bonus, and all these things can be demanded only when the company or the organization is earning well. If the company is not performing well, then labor unions will not have any that is say on the management, that is bargaining power will be lost by the labor unions. So that is about the importance of financial statement analysis. Now moving on to next part, that is objectives of financial statements. Objectives of analysis of financial statements. Objectives of analysis of financial statements. What is the rationale behind analysis of financial statements? Yes, first one is to access the current profitability and operational efficiency of the organization. First one is to know the position, current position and efficiency, operational efficiency of the organization. So analysis and interpretation is done to know how our company is performing, to know the position of the company, or what is the operational efficiency of the organization. This is one of the reasons why interpretation or analysis of financial statements is done. Second one is relative importance of, that is different components of the financial position of the firm. To know the different components, that is like sales, isn't it, or fixed assets, or reserves and surplus, how much is there in the business, we can know individually. Each of the items can be known individually through the financial statement. So, financial statement analysis is done. Third one is to find out the reason for change in profitability or financial position. Change in financial position. Financial position. That is, when the analysis is done, we'll come to know the change in the financial performance or operation efficiency or profitability. Everything can be made known by the management. So, this can be made known only when we interpret and analyze the financial statements. So, financial statement analysis gives a clear idea about what the change, whether it is positive change or negative change in the performance or efficiency. All those things can be made known by the management. Next one is judge the repaying capacity of short-term and long-term debts. Repaying capacity, as I already told you, this is very important. When you raise loan, your repaying capacity will be judged by the financial institutions who provide loans or the lenders who provide financial assistance to the organization. So, here in America it is common, friends. India, it is not known to most of the people. They have credit rating. Credit rating in the sense, depending upon your credit rating, you will get the loan from different banks or other financial institutions. Sorry. Yes, so loans and other financial assistance will be given only when the organization is in a sound position to repay the amount. So, likewise, individual capacity, that is repaying capacity, will be assessed. For that, in America, they used to do, that is a credit rating. Credit rating, there is some 36 points, something like that, out of which this much point must be there, otherwise the credit rating is bad. Bad in the sense, the payment obligation, repayment obligation, if it is deferred or delayed or not paid, then the credit rating automatically comes down. There will be different people who, that is agencies, who will assess the credit rating of each of the, that is individual in America. But in India it is not there. If you ask what is your credit rating, they may ask you, what do you mean by credit rating? First you have to explain the meaning of that. Then they will say, I don't know about this, I don't have any credit rating. They will come out with that answer. So you have to tell the meaning of that credit rating first to the people to ask a question on that, isn't it? It is not known to most of the Indians. So in America it is common, depending upon the credit rating they have. If it is very good, they will get that is a loan at a lower rate of interest. If the credit rating is high, risk is more, repaying capacity is less, isn't it? Risk is more. So the financial institutions will charge more interest for such customers. But it is not here, it is common to all the people, all the individuals, isn't it? So your repaying capacity of the organization can be made known only with the help of, that is analysis and interpretation of financial statements. Now, analysis and interpretation is required, of course, no doubt, but we should know how to analyze and interpret. What are the tools and techniques that are available to analyze and interpret the financial statements? There are different, that is tools or weapons through which the financial statements can be analyzed or that is interpreted, isn't it? They are most common among them are comparative statement. Comparative statements. Second one is common size statement. common size statement. Third one is trend percentages. Trend percentages. Fourth one is ratio analysis. And fifth one is cash flow statements. Cash flow statements. These are the 5 statements that are prepared. These are the tools of financial statement analysis. Remember friends, they may ask you in the examination what are the tools, mention any tools of financial statement analysis. Don't write profit and statement of profit and loss and balance sheet. They are the types of financial statements. When they ask you mention any 2 types of financial statements, then balance sheet and statement of profit and loss, segment report, auditor's report, isn't it? But when they ask you what are the tools or techniques of financial statement analysis, write any of these, any 2 points, you just write comparative statements, common size statements, trend percentages, ratio analysis and cash flow statement. These are the 5 tools available under which we will study these 2 first as one chapter. Then this is not there, it was there earlier, very easy it is, but it is removed during this last 2 years ago it was removed, isn't it? Then ratio analysis, separate chapter we have, one full chapter is there on ratio analysis. Here only formula, you will have only formula, nothing else other than formula. If you know the formula, easily you can solve it. A small chapter, cash flow statement. So we have 3 chapters left here, these 2 together, this one and this one is the small chapter. Clear? Now let us move on to the first one, what is comparative statement. Comparative statement. Very simple friends. Comparative statements, they are also called horizontal analysis statements. Horizontal analysis. And common size, they are called vertical analysis. Vertical analysis statements. Very simple. You will come to know while writing in comparative statement, we will compare 2 figures and we will write the difference and we will represent it in the percentage. That's a very simple thing, very easy chapter it is. Trust me, they will give you 2 years comparative statement, that is 2 years figures they will give of either a statement of profit and loss or balance sheet. Only one item will be given, one will be given, either there is a statement of profit and loss or balance sheet. What you have to do is, in case of comparative statement, you have to compare both the figures. Suppose if it is a 10 lakh suppose, and this year it is maybe 12,50,000. Then what you have to do is, you have to compare these and you have to write here positive, that is increase of 2.5 lakh, 2,50,000 during current year, correct? So you will write 2,50,000. When you write without bracket, it means it is positive figure, plus. Remember this. No need to write plus here, don't put the bracket. If you put the bracket, then it amounts to minus, that is negative figure. Suppose if last year it was 10 lakh and this year the profits are or sales are, suppose any figure for that matter, 7,50,000. So you have to write this within bracket. That is the speciality of this solution. Are you getting me? Any negative figure, put it within bracket, don't write plus or minus. If it is plus, without bracket write it. This is within bracket minus and this is without bracket, so it amounts to plus. If there is no bracket means it is plus, remember. Clear? Yes. So what we will do here is same thing. You will be given a statement of profit and loss, solved problem will be given. Sometimes they may jumble it. Isn't it? And on the basis of that, they will give you 2 years figures to you. Current year and previous year's figure. What you have to do is, you have to put it in the format. That is balance sheet format. First you have to take equity and liabilities. Sometimes they will give you in the format itself. So your work will be reduced. You need not struggle much there. Simply there is a work for the calculator, that's all. No work for your brain. Clear? You should know the format, you should know the columns. Simply writing the same thing, finding out the difference, and then calculating the percentage in case of comparative statement. Very, very simple. So, equity and liabilities, long term liabilities, current liabilities, isn't it? Non-current liabilities and current liabilities, 3 items. Assets, under that, non-current assets, then current assets, done. That's all. You have to place it in the order, in the balance sheet format. That is why I told, if you study this, you will be benefited from 3 angles. First one is practical oriented question is there, format of balance sheet, you can solve that. One problem of 6 marks will be there on financial statements, you can solve that. You will be given one problem either on comparative statement or on common size for 12 marks. You can solve it. Very, very easy. But I don't know whether this chapter will be there for the exam or not. That is very, very important. But it is the easiest chapter where the students will score at least 10 or 12 out of 12 or at least 10 marks in the board exam. This will help the students to get some good score, isn't it? But I don't know. If the syllabus is reduced, then I cannot guarantee anything regarding this chapter, because it is at the end, maybe removed or maybe kept as it is. I don't know. So let us see, when the information comes, definitely, immediately I will pass on the information to the students. Clear? Yes. Now, let us move on. Comparative statements here, what we have to do is, we have to compare the figures of current year figure with that of last year, and we have to represent the difference either positive or negative. If it is positive, without bracket; if it is negative, within bracket, isn't it? Without assigning the sign, plus or minus. Then what we have to do is, for this, how much is increased? For 10 lakh, there is an increase of 2.5 lakh. For 10 lakh, 2.5 lakh. For 100, how much? Calculate. Isn't it? So, 2,50,000 into 100 divided by 10 lakh. Whatever you will get is the percentage. Write it at the end. Here, maybe 25%. 25%. You will write the heading here in percentages, so no need of writing this, simply 25.00. You have to do this, and for each of the items in the balance sheet or the statement of profit and loss as given in the problem, you have to do the same thing, same work you have to do. Present it in the balance sheet format or statement of profit and loss, and write the figures of both the years. Compare it, write positive or negative, then reduce it to percentage. Your work is done. Once you complete it, then 12 marks easily you will get. Do you think there is any difficulty? No. Very, very easy, isn't it? So we will take up the problems in the next class, comparative statement problems in the next class. Take down assignment. Mention the different tools. Mention the different tools available. Different tools available for financial statement analysis. For financial statement analysis. Submit assignment on time. Thank you for watching this video. Thank you.
Don't forget to like our video and subscribe our YouTube channel for all the updates.